Google stock is moving to a new 52-week high after the company reported their Q2 earnings after the bell. On today's show, we'll obviously go through those Q2 earnings and take a look at the online ad business, which I just cannot believe is actually doing quite well at today's time. That is very impressive for this company. We'll take a look at the balance sheet, the cash flows, the fact that this company has been in cost control mode for the past 6 months or so. We'll see how those have flowed down to the cost side and the profit side for Google. And we'll come over here and look at it from the technical perspective. Like I said, I'm putting up a fake green candle on the chart, and we are moving to a new 52-week high over at Google and just resuming an uptrend that has been in place with this stock if this trend maintains itself. I tell you what, folks, we've got some higher upside ahead for Google. In fact, maybe quite a bit more upside. We'll discuss that when we get to that segment. What is going on, investors? Hopefully, guys are doing well out there. It is earnings season. It's time for Q2 earnings for Google. I'm not going to waste any of your time. Year to date, the shares of Google are up 37%. But over the last year, just up 13%, because when you stretch this out to a 10-year view, stock's up 438%. So the last year historically hasn't been that good for Google. So a lot of people are looking at these stocks and they're like, they've run so much, so fast year to date. Yes, year to date they have, but start stretching it out to a longer time frame. And guess what? These tech stocks could rally a heck of a lot more than they have and still be underneath the 10-year historical returns that these stocks have given you. Now, Google reported their Q2 earnings after the bell. Revenue coming in, they have here $74.6 million. When you come over here, you know that is not enough for Google. It is actually $74.6 billion for Google in terms of its revenue. That compares to last year where they put up just $69.7 billion worth of revenue. Now, what were the expectations? Wall Street was expecting a number close to $72.8 billion. The high-end estimate on Wall Street with 33 analysts was just $74.33 billion. So Google coming in over and above that. But here's the thing to understand as an investor is Wall Street plays these games with the estimates. And this time last year, the Q2 estimates for Google were as high as $83 billion. So if you rewind time to last year, Wall Street was expecting $83 billion, close to $84 billion. And again, they're making these estimates and assuming Google's going to come over them. So probably closer to $84 billion. Those were the expectations a year ago. Those have slid off the table to the expectations closer to, we'll call that $73 billion. So just keep in mind, when Google puts up a number of $74 billion, it beats the lowered bar expectation that Wall Street has. Last year, they were expecting closer to $84 billion. We just put up $74 billion. So understand that these estimates are a sliding scale and they're a moving target in a lot of ways. But let's not miss the forest through the trees in the fact that the advertising business over the last year, advertising went up from $56.3 billion all the way up to $58.1 billion. YouTube ads coming back from $7.3 billion last year all the way up to close to $7.7. Just your straight search and contextual based ads from $40.7 all the way up to $42.7 billion. Your Google Cloud, also explosive growth from $6.3 billion all the way up to $8 billion. And we've noted it here numerous times here on the show is that business unit has finally turned profitable. They turned another profitable quarter, at least from an operating perspective, on Google Cloud. So off of this $8 billion worth of revenue, they realize about $400 million in profit. Now, $400 million to a company doing $74 billion worth of revenue, not exactly moving the needle, but obviously this growth rate, we're assuming this growth rate, while it may not be this spectacular for a really long period of time, we're assuming a growth rate here for many, many, many more years. So this is a company that's cloud business could continue to generate more operating profits. The ad business went from $21.6 billion. Again, this is operating profit. This is more or less your profit. Again, increased from 21.6 all the way up to $23.5 billion over the last year. Very impressive, needless to say. When you look at the company from kind of a total perspective, here's your revenues of $74.6 billion. Here's what I want to show you, because obviously Google and a lot of these tech stocks have been making news, not just with AI, but earlier in the year, all the cost cutting that they were doing. Look at your cost of revenues. They barely budged from 30.1 all the way up to, we'll just call that about $32 billion. Your R&D, now we did see a nice meaningful tick up here from 9.8 up to about $10.6 billion. You have to assume there's a lot of AI stuff built in there, but there's also a lot of stock-based compensation built in that as well. So it's not all cash. And then finally, you get to sales and marketing. Despite meaningfully higher revenue based on where we're at in the ad cycle, not meaningful increase in sales and marketing. Went from 6.6 up to just 6.8. And where they shed a lot of costs, or at least keeping them under control, is your general administrative. 3.7 billion down to, we'll call that 3.5 billion. Your total costs and expenses up just $2.5 billion over the last year to $52.8 billion. Your income from operations coming in close to $22 billion. Net income, 18.4. That's an increase of last year where you did $16 billion. And they continue, when we'll show you this on cash flows, to reduce the number of shares outstanding. Here's the aforementioned cash flows. You pull down your net income number of $18.4 billion. We're adding back depreciation. Here's your stock-based compensation, up a meaningful $1 billion over the last year. A lot of that probably in that R&D expense. Anytime you see a company increase their R&D expense, those tend to be engineers that want to be paid in stock-based compensation because they're being tasked with creating kind of those revenue-driving products for the company. And so you come down here to net cash provided by your operating activities. Yeah, you went from 19.4 all the way up to $28 billion. And again, I want to remind everybody, so we're not just blazing through these numbers. This is for 3 months, okay? I know, look, it depends on what kind of companies you're looking at on a regular basis. We're talking about $28 billion, not of revenue, not of operating profits. We're talking about cash flow to the bank, operating the business, $28 billion. And what I noticed, and here's what I was concerned about, not necessarily concerned about, but very curious about, are the investing activities over at Microsoft, at Google as well, the purchase of property, plant, and equipment as they have to build out these AI servers and they have to, build out more servers, put fans in there, get all the optical wire and all that stuff. All that stuff costs a fair amount of money. And we see here over the last year, just fractionally higher on the property, plant, and equipment. So this is a company that already had kind of made a lot of those investments, and they did a lot of cost cutting on top of that. So not a huge impact from that. That's still going to allow the company to repurchase a boatload of stock, about $15 billion in the most recent quarter. So what you're looking at is a company that is essentially cash flow neutral. So the cash they bring on the operating side, some of it goes away on the investing side. A lot of it goes away on the repurchase of stock, but the cash balance over at Google stays relatively constant year over year. The company still has a mountain. I mean, we're talking about a mountain. This ends up being a 6-month view of cash from 113 at the beginning of the year all the way up to 118. It's balanced off by a tiny amount of long-term debt at 13.7. This is obviously a cash-rich company that, is about to move into the AI era and generate lots more services and products off of that. Yeah, guys, this is why the stock is moving to new highs from a technical perspective. Obviously, those of you that follow our channel and watch our Friday recap show, we cover the technical chart pattern of Google every single Friday. There are timestamps in there if you just want to jump to the technicals or the stocks that interest you the most. What we are looking for, in the longer term, the shares of almost all of these mega cap stocks are pretty much doing this for the past, almost their entire history. They're making higher highs, higher lows. We had the major pullback end of 2021 into 2022. 2023 has been more of a recovery. We still want to see actually shares of Google and a lot of these stocks return to the highs. For Google, that is all the way up here at about $152 per share. In the after hours, shares of Google are trading close to $130. So we still have $20 or more of upside before you return to the highs. And then when you look at Apple, you look at Microsoft to a lesser degree, these shares of these companies are pushing to new highs. So if you've been sitting on the sidelines, if you've been wondering about this AI trend, if you're wondering if you should be getting back into stocks or if it's too late, it absolutely is not too late. Google has just pushed through a resistance area here, which was kind of a hard red line anywhere between 125 up to roughly about where the shares are trading now at about 128. A close tomorrow in the 130 range. Very bullish for Google in the shorter term to return to the highs. The thing I'm most impressive about, folks, is the fact that this company's ad business is actually doing well. That is going to beat down a lot of the narrative that we are in a recession or a recession is coming. Online ads just simply would not be doing well if businesses were not confident about the other end of that ad, which has to be a conversion or a purchase. This company is looking pretty darn good to me. And if we layer on some kind of AI service or the ads just get incrementally better with the AI, this is a company that trading at just 22 times forward earnings. Those earnings have a strong likelihood of increasing down the road, making this 22 times forward actually lower than what it appears on paper. That was Google. I do not own any shares of Google, so this was more or less an unbiased review. Hopefully you guys stick around for Microsoft, which that video will be coming after the company's conference call. Until next time, good luck with your investments.